Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello everyone, my name is Manpreet and welcome to Through the Noise. Now, since the start of the year, we've had quite a bit of focus on the AI theme and some of the risks around it, and we've got, of course, some more information on that through the current earnings season. But in the last week, we've also had a few key policy developments as well, with the headline banner, of course, being the US Supreme Court decision on tariffs. And besides, of course, the policy developments, a few sort of key risks out there that we're keeping a close watch on. So, what does this all mean for investment portfolios? To discuss this, I'm joined today by Rajat Bhattacharya, who's a senior investment strategist in the CIO office. Welcome, Rajat, and thank you for taking the time to speak to our listeners today. Let's start with the US Supreme Court decision. I mean, that's something markets had been anticipating for quite some time, but given the outcome, what do you see as the key implications for investors?
Thanks, Manpreet. Yes, that was a big news over the last weekend. The main conclusion, I should say, from the latest Supreme Court ruling is that US tariffs have peaked. Now, the government is likely to recreate most of those lost tariffs through other statutes to meet their revenue targets, and this is expected. However, I should add that the net impact of the court ruling is marginally positive for risk sentiment because it reiterates the checks and balances in the US political system. For investors, to answer your question, it's more important, I think, now to focus on the global fundamentals and liquidity backdrop, and that remains supportive of risk assets. In fact, as you mentioned there, we have just raised our AI capex growth estimates following this strong earnings season, following the semiconductor industry's guidance, and that remains very positive.
Thanks, Rajat. I think that AI guidance is something I do want to come back to. But before we go there, could you tell me a bit more about your assessment of the US economy following the Supreme Court decision?
Sure. The main takeaway, as I mentioned there, is that the court ruling restricts the president's ability to impose long-term tariffs without congressional approval. Now, this is key. Now, while Trump responded by imposing a 10% tariff, that's only going to be lasting for only 150 days before he needs to seek the Congress approval again. And he's he's imposed those tariffs under a different legislation, he's proposed to increase that rate to 15% for now. The overall effect, I would say, is that it's going to be marginal because US tariffs have ultimately peaked. We are not unlikely to see higher tariffs from here. And especially given their unpopularity heading into November's midterm elections, I don't see a chance of those tariffs going higher. If anything, they're going to go lower. As a result, our pro-risk investment strategy remains intact, which is anchored on the strong fundamentals and supportive liquidity. We do see the peak US tariff, fiscal stimulus from last year's tax cuts, lower borrowing costs as a result of the Fed rate cuts last year, and we do anticipate more cuts coming, and the AI driven investments underpinning US corporate earnings. The US dollar's recovery, I should say, add, since January is likely to fade, however, because of the fiscal deficit concerns, because tariffs are going to go down, and that's going to bring in lesser revenue for the government. Meanwhile, US government bond yields have dragged lower over the past week amid concerns about negative impact of AI on various sectors.
So that's a really good segue to come back to the AI story. Now, earlier you mentioned that we'd upgraded our AI capex growth estimates. So can you tell our listeners a little more about that?
Yeah, the basis for that is that the semiconductor industry has had a very strong fourth quarter 2025 earnings season. And the ongoing AI investment is fueling demand for high end chips. We now estimate that the 2026 global AI capex growth of 54%, and this is up from 45% previously. And we now see a compounded annual growth rate for the next 5 years, that is 2026 to 2030, of 27%, up from 26% previously. I should say that we are still in the early stages of the AI investment cycle, which will benefit the semiconductor industry. Consensus 2026 earnings growth estimates for that particular industry, semiconductors, that is, have been revised up to 56% from 53%, outpacing the broader technology sector's growth. Now, the significant AI capex is also likely to benefit companies involved in data center build out. The thermal management and the power supplies are key areas in data centers, as we know, and this is helping benefit the service, the utilities. For instance, the grid upgrades need to be done, and the utilities and the services providers towards that are benefiting from this surging in demand.
What about the software sector? I mean, that's really borne the brunt of some of the concerns around AI.
Indeed, the software sector has significantly underperformed the broader technology sector so far this year. Now, a rebound is possible following partnerships announced by leading AI research lab with other software companies, which eases concerns that AI agents will cannibalize the enterprise software demand. However, I should add that near term sentiment will likely remain pressured by lackluster earnings guidance from major software players. We expect the software sector volatility to persist as a result and recommend a selective approach in this area. There is continued pressure on front end platforms focused on customer engagement, human resources, and visualization as they face greater AI displacement risk. Firms with high employee cost intensity are also vulnerable to AI driven disruption. In contrast, infrastructure software, including operating systems and cybersecurity, is more resilient, supported by high switching costs and deep customer integration. So, overall, I would conclude that we favor sectors benefiting directly from the rising AI capex story, which is the internet and semiconductor sector, over the software sector.
Thanks, Rajat. I think let's given the time, let's move on to other themes. So there've been some developments in Japan, particularly changes to the board of the Bank of Japan. What do you see as the implications for Japanese financial markets?
Yeah, the big news last week was Japan's Prime Minister Takaichi appointed two reflationist academics to the Bank of Japan board, signaling a more dovish monetary stance after earlier reportedly expressing concerns about BOJ rate hikes. Now, the dollar yen, Japan bond yields, and the equities all rose following this announcement. Now, money markets are now expecting the next BOJ rate hike sometime in June or July, but a dovish tilt to the BOJ board could stagger rate hikes, especially after headline inflation cooled in Japan and in Tokyo below the BOJ's target for the first time since 2022. Now, the beneficiary here is the Japan stocks. Japanese stocks have been performing well lately, even with yen strength, which suggests that the domestic driven reflation story, aided by Takaichi's fiscal stimulus plans, is starting to become a bigger positive driver of the equity market than yen weakness. We are monitoring the evolving policies closely. A reflationary BOJ slant and Takaichi's apprehensions against the BOJ rate hikes, along with her fiscal stimulus plans, presents an upside risk to the equity rally in Japan.
Thanks, Rajat. I guess that's key developments in Japan, but what else should we be watching in across Asia? Is anything significant upcoming from a policy perspective?
Yes, the big one, Manpreet, is the China National People's Congress. Now, at the NPC, China is expected to set a, I would say, 4.5 to 5% GDP growth target for this year, which is slightly below the 2025's goal, but it's consistent with its ambition to become a moderately developed economy by 2035. Now, policy is likely to aim to boost consumption and innovation, countering deflationary pressures. We expect very modest fiscal support in the coming year as trade uncertainty ebbs. And also, we expect modest cuts to bank reserve requirements and policy rates, along with ongoing central bank bond purchases. So, overall, we remain bullish on the China equity story, especially in the technology and communication services sector, where valuations are still more attractive than their US counterparts.
All right. And very quickly before we close the podcast, we've talked about a lot of the potential upside, but where are the risks? What are you watching on that front?
Yeah, the big one is Iran, of course, and we see a temporary rise in oil prices, maybe towards 50 towards $70, I should say $70 per barrel, should the U.S. Iran tensions flare up. Uh, but that's likely to be temporary. Our base case is a temporary spike in oil prices, following patterns we have seen in July 2025. After the spike, prices are likely to retreat towards $60 per barrel amid ample global supply. However, I should add that sustained disruption of Middle East supplies, if there is a blockage in the Strait of Hormuz, for example, could drive prices higher above $80 per barrel. But that's not our base case. On the whole, gold stands to benefit both from this any such short-term geopolitical tensions, as well as the structural demand for EM central banks, as well as from investors. And this is why we remain bullish on gold, and we expect gold to reach at least 5,350 within the next 12 months.
Thanks, Rajat. And I think on that note, we'll sort of end the conversation there. Thanks so much for taking the time to speak to our listeners today. As always, my top three takeaways. Number one, many of the policy developments, the US Supreme Court decision, policy changes in Japan, of course, good for our pro-risk stance in portfolios and particularly for equities. Second is that, learning from AI earnings and capex plans, we think that's positive for the semiconductor and internet subsectors over software. And third, of course, we still like gold, as a hedge, but obviously going beyond that. So thank you very much for listening to the conversation today. We hope you found it useful, and we look forward to speaking with you again next week.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.